America is entering economic shock, and the first signs are already here. Major warehouses across the U.S. are shutting down. Automakers like Ford and GM are cutting jobs on a scale not seen since 2008. Just this week, more than 21,000 auto jobs vanished across Michigan, Indiana, and Ohio. Why? Because Trump's reckless tariff war is backfiring hard.
One Detroit auto supplier says he's going to have to lay off employees and close a warehouse because of the president's tariffs.
And now, Trump has made it worse. Much worse. After months of threats, the tariffs are officially in effect.
The director of the National Economic Council, Kevin Hassett, telling the American people to relax, that the, quote, tariff uncertainty period is behind us. But for a lot of business owners, the future is still very much uncertain.
Since May, U.S. tariffs on Chinese and other BRICS goods have surged, sending the cost of raw materials like steel, aluminum, and microchips through the roof. Auto parts prices alone have jumped over 37%, forcing production lines to stall. Warehouses are crammed with inventory that's either too expensive to move or stuck in customs due to retaliation from China and Brazil. A new U.S. Chamber of Commerce report warns that more than 2,000 supply chain-dependent businesses could shut down within the next 90 days if tariffs stay in place. This is a slow-motion collapse of America's backbone industries, logistics, transport, and manufacturing, unfolding right now. In this video, we break down the data, the damage, and the devastating truth behind Trump's tariff disaster. The worst is just beginning. Before we dive in, make sure you're subscribed. It's the only way to keep getting the most important updates on the global economy. Now let's get into the details. Donald Trump told Americans he would save U.S. manufacturing. He promised the auto industry would be one of the biggest winners. His message was clear. Tariffs on foreign cars and parts would protect American jobs, boost local production, and give automakers the edge they needed. This was a rallying cry in states where factories had been shutting down for decades. People were told tariffs would mean more cars built in America by American workers. But the numbers from 2025 tell a very different story. The U.S. auto industry has not made real progress this year. Many problems have actually worsened. The same tariffs meant to protect the industry have added huge costs, and analysts warn that about 30% of the auto industry could be lost because of them. Cars today are built from parts sourced all over the world. Engines, electronics, sensors, and steel often cross borders multiple times before final assembly. Tariffs on those parts mean automakers must pay more just to keep production running. Industry studies show a 25% tariff on vehicles, and parts can add over $100 billion in extra costs across the U.S. auto sector. Those higher costs are hitting every part of the business. Ford, GM, and Stellantis have all reported losses tied directly to the tariffs. Toyota cut its profit forecast, warning of a $9.5 billion hit from the trade measures. These losses mean less money for building new factories, upgrading old ones, or keeping workers employed. Smaller part suppliers, who can't easily pass costs on to consumers, are cutting jobs too. Analysts say tens of thousands of jobs could be at risk if the situation continues. For workers, this is the opposite of what they were promised. In towns where auto plants are the main employer, even a few hundred layoffs can hit hard. Local shops, restaurants, and service businesses lose customers. Tax revenue for schools and community programs falls. And when suppliers cut jobs, those layoffs often happen quietly, without the same media coverage. But the damage to local economies is just as real. Consumers are also feeling the squeeze. Tariffs act like a tax on every imported part, and that cost is passed on in the price of the car. Experts say tariffs can add thousands of dollars to the sticker price of certain models, making new cars harder to afford at a time when interest rates are already high. As a result, more people are buying used cars or delaying their purchase entirely. In June 2025, new car sales fell compared to the same month last year, with analysts pointing to rising prices as a main reason. Even when sales increase slightly, profit margins are shrinking because the costs to build each car are so much higher. Industry leaders are no longer keeping quiet. Automakers and trade groups have been lobbying the White House to ease or remove some tariffs, warning that if costs keep rising, more production will move to countries with lower trade barriers. exactly the opposite of what the tariffs were meant to achieve. Some concessions have been made, like small tariff cuts on certain parts, but these are temporary fixes that don't solve the core problem. Constant uncertainty makes it harder for companies to plan investments that take years to pay off. Meanwhile, the US auto industry faces other big challenges. Electric vehicle production requires expensive new factories and battery plants, but companies are delaying or scaling back these projects because of the added financial pressure from tariffs. Without those investments, the US risks falling behind in the global EV race. And while foreign competitors are building cars more cheaply, American consumers are paying more for fewer options. The result in 2025 so far is clear: higher prices, declining sales, job losses, and stalled investments. Tariffs were supposed to be a lifeline for US automakers. Instead, the industry is struggling to keep its head above water. Analysts warn that without major policy changes, the second half of the year could bring even bigger layoffs and more factory slowdowns. For the workers and communities who believe these promises, the gap between what was said and what has happened is growing larger every month. So far in 2025, job cuts in the US auto industry have kept coming, and the numbers keep climbing. In April, Stellantis announced it was temporarily laying off around 900 workers in Michigan and Indiana. Production at related plants in Canada and Mexico was also paused. This followed another 1,100 jobs lost earlier in the year at its Jeep Gladiator pickup plant in Toledo, Ohio. These were well-paid manufacturing jobs in areas where local economies rely heavily on auto plants. General Motors has also been forced to freeze jobs at its technical center in Chicago, affecting design, engineering, and office roles. For now, operations are paused because the company can't get the materials it needs, all thanks to the tariffs. GM's Cruise self-driving division has eliminated nearly 1,000 positions and more than 1,000 salaried employees, including about 600 near Detroit, have been let go as part of wider cost-cutting. In each case, the cuts are directly tied to the higher costs companies face this year. The layoffs aren't limited to Detroit automakers. In July, Daimler Truck announced it would cut 2,000 jobs across its US and Mexican operations. The company has warned that current tariffs could cost it several €100 million this year, forcing it to scale its workforce to match slower production. When these figures are added up, the result is nearly 8,000 direct auto industry jobs lost in 2025. And that doesn't include the smaller suppliers making seats, electronics, or metal parts, who are now shedding workers too. These supplier layoffs often go unreported but still shrink job opportunities in the same communities. At the same time, the cost of building a new vehicle has surged. Industry data shows that tariffs not only making cars more expensive, but insurance as well. With higher interest rates, monthly payments have risen, making new cars harder for many buyers to afford. Without buyers, companies cannot invest in innovation. Some have already slowed or delayed investment in electric vehicle production and battery plants in the US. Without those projects, there will be fewer new jobs to replace the ones already lost. While the auto industry struggles, Trump has just made things worse. Tariffs are now in place across the world, and you're going to notice the impact soon. After months of threats, the Trump administration officially enacted the tariffs on Thursday.
We won't know the full effect. And besides inflation, there'll be slowdown in growth. That's an almost certainty.
Right now, the full effect hasn't yet hit stores. Some goods shipped before the tariff deadline are still arriving under old rates. But once that inventory is gone, every new shipment will carry higher tariff prices. And that's when you'll see the difference on your bills. Economists expect slower growth, higher inflation, and more job losses. The exact scale is unknown, but the direction is clear. There's also a major shift at the US Federal Reserve. President Trump has nominated Dr. Stephen Miron, a key figure in shaping the administration's trade and tariff policies, to fill an open seat on the Fed's board. Miron supports quickly lowering interest rates, which will put more pressure on the Fed to cut rates in upcoming meetings in an effort to blunt the economic damage from tariffs. The first signs of strain are already visible in consumer goods. Many companies have delayed price hikes to avoid losing customers, but their limits are near. Nike says tariffs will cost them around $1 billion. Adidas projects about $230 million in US losses. Walmart has warned that higher prices are coming. General Mills says aluminum tariffs alone will add $20 to $35 million to its costs. These companies now admit they can't absorb these expenses much longer and will soon pass them on to consumers. The White House insists foreign exporters will lower prices to keep selling to US buyers, reducing the tariffs' impact. In practice, US importers pay the tariffs first. While exporters sometimes offer discounts, executives point out that with profit margins as slim as 2 to 3%, they can only do so for a few more months before prices rise. Michigan is already feeling the hit. Herman Miller, a century-old furniture company, is closing a plant and cutting 130 jobs. Families are paying more for food, school supplies, and everyday goods. The state is collecting data on the total economic impact, but the cost increases are already visible. Governor Whitmer has met with President Trump 3 times since the tariffs were introduced to raise concerns. Lieutenant Governor Garland Gilchrist says Michigan will keep pressing the administration about the damage to local businesses and workers. While states can't overturn federal tariffs, they can try to give residents financial relief and help keep businesses afloat. On the political side, Vice President J.D. Vance is urging Republican-led states to redraw their congressional maps before the decade ends, following Texas's example. Gilchrist says Democratic-led states should use every legal option to counter such moves. The important point is how this hits your own wallet. When companies like Nike, Walmart, and Ford pass along these costs, you'll see them in everyday purchases. This isn't money coming from foreign governments. It's collected from US importers who recover it from you through higher prices. History also shows tariffs fuel retaliation. In Trump's prior term, tariffs caused $51 billion in losses for firms, raised consumer costs, and failed to bring factories back, hitting hardest in regions central to his political base. If nothing changes, the coming months will bring more price hikes on food, clothing, electronics, furniture, and cars. Job losses will mount, especially in manufacturing-heavy states. The economy will adapt, but for workers and families, that adjustment will mean paying more and possibly earning less. This is only the beginning. We'll continue following the story and bringing you the latest updates. So make sure you're subscribed.